Imagine you are standing in a grocery store aisle looking at two nearly identical products. One costs $3.79. The other costs $4.19. The difference is 40 cents, smaller than most people would bend down to pick up off the sidewalk. And yet research in behavioral economics shows that this tiny gap changes purchase behavior more than a $5 difference at higher price points. Something strange happens when numbers cross certain invisible lines, and those lines are not random. They are rooted in how the human brain processes quantity, risk, and scarcity, often in ways that have nothing to do with rational calculation. There is a specific dollar amount that appears again and again in financial psychology research, a threshold where spending behavior, saving behavior, and even debt perception shift dramatically. That number is $3,784. To understand why this number matters, we have to first understand a concept called mental accounting, a term coined by Nobel Prize-winning economist Richard Thaler. Mental accounting refers to the fact that people do not treat money as fungible, meaning they do not treat every dollar as identical to every other dollar. Instead, people assign money to different mental buckets based on where it came from, what they plan to use it for, or even how they feel about the number itself. A $50 bill found on the street is spent more freely than $50 earned from an hour of work, even though both can buy the exact same sandwich. A tax refund feels like a bonus even though it was always your money. And a credit card purchase feels less painful than cash even though the total outlay is higher. These mental buckets are not irrational in the pejorative sense. They are the brain's attempt to simplify an overwhelmingly complex financial world. But they also create predictable distortions, and those distortions become most visible when a single expense or a single financial target crosses a specific numerical boundary. But they also create predictable distortions, and those distortions become most visible when a single expense or a single financial target crosses a specific numerical boundary. The threshold of $3,784 emerges from research on what economists call the liquidity constraint boundary. Below this amount, people tend to treat unexpected expenses as manageable annoyances, absorbed by reducing discretionary spending, skipping a few restaurant meals, delaying a non-urgent purchase, or pulling a little from next week's paycheck. Above this amount, people begin to treat the same expense as a financial crisis requiring debt, asset liquidation, or major lifestyle change. The number appears in studies of car repairs, where researchers found that a $3,500 transmission repair triggered a completely different emotional and behavioral response than a $3,900 repair, even though both represent similar proportional hits to household income. The same pattern appears in medical bills, home maintenance, tax underpayment penalties, and even veterinary emergencies. $3,784 is roughly the median point at which an American household shifts from saying, "We can figure this out," to saying, "We are in trouble." But the threshold is not just about affordability, it is about psychological categorization. Below this line, an expense stays inside the monthly cash flow bucket. It is processed by the part of your brain that handles routine variability, the same part that decides whether to buy coffee today or wait until tomorrow. Above this line, the expense moves into the savings or debt bucket, and that move activates a completely different neural network, one associated with long-term planning, scarcity monitoring, and threat detection. When an expense is categorized as a cash flow problem, you look for solutions within your normal routines. When it is categorized as a wealth problem, you start asking much bigger questions about your life, your choices, and your future. That shift in categorization changes not just how you solve the problem, but whether you believe the problem is solvable at all. Here is the math that makes this threshold so powerful. The median American household has approximately $2,500 in readily accessible liquid savings, not counting retirement accounts, home equity, or investments that carry penalties for early withdrawal. $3,784 is roughly 1.5 times that median buffer. When an expense exceeds your liquid buffer by 50%, your brain no longer categorizes it as a cash flow problem, it categorizes it as a wealth problem. And wealth problems trigger a completely different set of psychological responses. Instead of asking, "How do I adjust my spending this month?" you start asking, "What do I have to sell? Who do I have to borrow from? How long will it take me to recover? And whether this is a sign that I am failing financially." That shift in framing changes the emotional weight of the decision, and changed emotional weight changes behavior in ways that often make the financial outcome worse, not better. Consider what happens when you owe $3,000 on a credit card versus $5,000. The $3,000 balance feels like a project, something you can tackle with a few months of disciplined payments, something that has a clear end date you can visualize. The $5,000 balance begins to feel like a permanent condition, something that will always be there no matter what you do, a background hum of financial stress that never quite goes away. This is not just a feeling. Studies of debt repayment behavior show that accounts with balances below approximately $3,700 are paid off at significantly higher rates than accounts with balances above that line, even when controlling for income, interest rates, minimum payments, and credit scores. Something about crossing that number changes the debtor's belief about whether the debt is conquerable. And that belief becomes a self-fulfilling prophecy. People who believe they can pay off a debt take actions that lead to paying it off. People who believe the debt is permanent stop trying, miss payments, accrue fees, and watch the balance grow. The same pattern appears in savings goals. Researchers studying workplace retirement plans found that employees who set a savings target below $3,800 were substantially more likely to reach that target within 1 year than employees who set a target above that amount, even when the higher target was only a few $100s more. The explanation lies in what behavioral economists call goal gradient effects with threshold discontinuities. Human beings are highly motivated to reach a goal that feels close, but demotivated by a goal that feels far away, and the transition between close and far is not smooth. There is a cliff, not a slope. $3,784 appears to be a common cliff edge in the American financial context because it sits just beyond the range of what most people can realistically save in 3 to 6 months without extreme sacrifice. Below the cliff, the goal feels like a matter of time and discipline. Above the cliff, the goal feels like a matter of luck or windfall, something outside your control. What makes this threshold even more interesting is that it scales with income but not proportionally. A household earning $50,000 per year and a household earning $150,000 per year both exhibit a similar psychological boundary at roughly 1.5 times their accessible liquidity. The absolute number is not the same for everyone. The real mechanism is the ratio between the expense and your perceived financial buffer, not the nominal dollar amount. However, researchers have identified $3,784 as a statistically significant anchor because it represents the median threshold across a wide range of income levels and household compositions. Below this amount, the majority of people in a given study reported feeling in control of their financial situation. Above this amount, the majority reported feeling out of control. That crossing point, from perceived control to perceived loss of control, is where financial behavior becomes most erratic and where people are most likely to make decisions they later regret. This has profound implications for how we should think about financial planning. Most conventional financial advice tells you to save 3 to 6 months of expenses for an emergency fund. That is good advice in principle, but it ignores the psychological threshold problem entirely. If your monthly expenses are $3,000, a 6-month emergency fund is $18,000. A number that feels so impossibly far away for most people that they never start saving at all. They look at $18,000, do a quick mental calculation of how long it would take them to save that amount given their current income and spending, and conclude that the goal is unrealistic. So they save nothing, or they save sporadically, or they save for a few weeks and then give up. But a first-tier emergency fund of $3,784 is a different story. That number is high enough to cover most common emergencies, a car repair, a dental procedure, a necessary plane ticket, a replacement appliance, without being so high that it feels unattainable. Once you cross that threshold, the psychological experience of financial security changes measurably. Unexpected expenses no longer trigger a crisis response involving panic, shame, and avoidance. They trigger a cash flow response involving calculation, prioritization, and action. And that shift in emotional framing reduces the stress that leads to poor financial decisions, like borrowing at high interest rates, liquidating investments at bad times, or making impulsive cuts to important spending categories like preventive health care or professional development. The person with $3,800 in savings experiences a flat tire as a $200 problem, annoying but manageable. The objective difference is only $1,800 in savings, but the subjective difference is the entire emotional landscape of money. The historical parallel here is surprisingly precise. In 1974, the United States Congress passed the Employee Retirement Income Security Act, which among other things created new rules for pension funding. Actuaries at the time identified a similar threshold effect in how companies funded their pension obligations. Companies with funding gaps below approximately $4,000 per employee tended to address the gap through normal operating cash flow, adjusting other budget categories, delaying non-essential projects, or reallocating existing resources. Companies with funding gaps above that threshold tended to restructure, borrow at unfavorable rates, or even terminate pension plans entirely, actions that imposed far greater long-term costs on the company and its employees. The specific number has changed with inflation, but the behavioral pattern has not. There is always a line where a manageable shortfall becomes a perceived catastrophe, and crossing that line changes organizational behavior just as predictably as it changes individual behavior. Another parallel comes from the study of poverty traps in development economics. Researchers have found that farmers in low-income countries who have access to a small buffer stock of savings, typically an amount equivalent to about 2 weeks of food expenses, make systematically different decisions than farmers who do not have that buffer. Farmers with the buffer invest in higher yield seeds, take calculated risks on new techniques, and spend time learning new skills. Farmers without the buffer make conservative, survival-oriented choices that keep them poor. The threshold amount varies by region and crop prices, but the ratio is remarkably consistent, approximately 1.5 times the cost of covering a typical small emergency. In the United States, that same ratio points to a number between $3,000 and $4,000. The scale is different, the currency is different, but the psychological mechanism is identical. Below the threshold, every unexpected expense is a potential crisis that triggers a cascade of stress hormones and narrows your cognitive bandwidth, leaving less mental capacity for work, relationships, and long-term planning. Above the threshold, unexpected expenses become ordinary problems with ordinary solutions that you can solve without derailing your entire week. That is not a small difference. That is the difference between living in survival mode, where the primary financial goal is making it to the next paycheck without disaster, and living in management mode, where the primary financial goal is allocating resources toward things that matter to you. Survival mode is exhausting. Management mode is sustainable. The threshold between them is not measured in years of income or complex financial ratios. It is measured in a single number that sits within reach for most households within 6 to 12 months of focused but not extreme saving. The calm closing thought is this: financial thresholds do not change the math of money, but they change the psychology of money, and the psychology of money determines the choices you make every single day. $3,784 is not a wealth goal. It is not retirement. It is not financial independence. It is a freedom goal, a relatively small amount of money that buys you something extremely valuable, the ability to experience an unexpected expense without experiencing a crisis. It is the amount at which most people stop feeling like money is happening to them and start feeling like they are happening to money. Whether your number is exactly that or something slightly different based on your own expenses and income, the principle holds. Find your threshold. Cross it. And notice how differently the world looks on the other side, not because you are rich, but because you are no longer brittle.